Hello and a very warm welcome to BNSN on campus. Kamya Verma. Let's first up take a look at the markets at this point of time. Nifty up in trade by about 0.1%, and it's clearly a bit of a volatile, but has been a range-bound session so far. Still managing to hold out in the green zone. Sensex also up in trade by about 0.2%, has given up those early gains, but still managing to hold out. The broader markets, on the other hand, are doing, in fact, better than the benchmark, especially the mid-cap pack, which is gaining about a good 0.3%. Some stocks that are holding out very smartly are NTPC, Vedanta, Bajaj Auto, as well as GAIL. But let's get you some top stocks to keep on your radar. And first up, Reliance Infra. Keep that on your radar, as Reliance Cement is in focus. Blackstone, Birla Corp, and Baring PE Asia are in the final race. Final offers at enterprise value of 4,000 to 4,200 crore rupees. Reliance Infra up in trade by 1.5%. NPCC, keep that on your radar, as it wins contract worth 328 crore rupees from NTPC Bihar State joint venture. Rico India has been up and about in today's session, and we connected with the management, who said that they've not declared results due to unprecedented case. New auditors taking more time than required, and they are trying their best to expedite the process. Aurobindo Pharma, on the other hand, gets tentative US FDA nod for esomeprazole magnesium. Now remember, this drug is a capsule for treating stomach ailments. Good going for this counter as well. Lawson & Toubro in focus, as its IT subsidiary L&T Infotech plans to raise over 2,000 crore rupees via IPO. Proceeds would be used to fund its future growth plans, and they filed a draft red herring prospectus with SEBI in September 2015. EPC Industry is also holding out very smartly in today's session. 4.5% of an uptick coming in there, as Reliance Capital buys 3.5 lakh shares at 147 rupees per share, and Pay1 Enterprises sells about 4.5 lakh shares at 147.5 lakh shares. Those are some of the top stocks that you should be keeping on your radar. But it's BNSN on campus that's back, and today we bring you a special segment live from the Jamnalal Bajaj Institute of Management Studies, where Avanne will interact with two market experts and several students who will try to understand the dynamics of the stock markets in an educational and interactive session. Avanne is standing by. Let's go over. Avanne, what's the latest there?
Well, educational and inspirational is indeed what it promises to be, Kamya. So this time around for BNSN on campus, we've traveled to the south of Bombay and come to the coveted B School, Jamnalal Bajaj Institute of Management Studies. I have with me our two very interesting market experts, but I've got a bunch of very enthusiastic, bright young students. They're first-year students of JBIMS, who will be asking their market-related questions as well. So let's not waste any time and introduce our two experts who will be guiding us over the next 30 minutes with their market knowledge as well as their in-depth insight, and we'll also get their New Year's resolutions for the market. Joining in on the show, we have Kalpen Parekh. He's the Managing Director of IDFC Mutual Fund, as well as Taher, Badshah, Senior VP and Co-Head Equities at Motilal, Oswal, AMC. Gentlemen, lovely to have you both with us. Thank you so much for joining in. And given that it's just a few days left for the new year, I'm going to talk a little bit about the outlook for the markets. And interestingly, you know, Kalpen, you had Carlos Slim, who said that anyone who's not investing right now is missing a tremendous opportunity. On that very optimistic note, let's enlighten our young students as to what kind of an opportunity the market holds right now, and what are your views for first-time investors.
I think for first-time investors, it's all about getting started, and you know, all of you are about to venture into your professional world once you complete your studies. So it's very important that right from day one you start the concept of investing. The most successful investor in the world, which most people talk about and do not follow, is Warren Buffett, and he says that I started investing at the age of 11, but I repent that I was 11 years late. So just imagine, the whole idea is the sooner you start, the more your money gets time to compound. If you are on an average at, I assume, 23, 24, mostly we have noticed that investors start disciplined investing at the age of 40, and they lose the first 15 years. The value of these 15 years will be realized in your last 15 years. And that time you can't do anything. The only time you can change the future is not in the future but now. So if I wish, when I was in NMIMS, I had got this opportunity to hear from someone to start very, very early. So the only advice I would give right now is, it's not about where to invest, which is so important. It's about when to invest and not waste a single day, and start with basic principles of investing. What are these basic principles that I have learned? It took me 10 to 12 years to learn and then start following. I can try and crunch that time for you. The basic principles are: invest regularly, come what may. So whether it's day or night, whether it's good markets or bad markets, your job is to keep investing. Everyone has his own duty. The duty of an investor, the word investor means you have to invest. So if you have savings, keep investing. Then the second question is how to invest. Invest every month, because when you start your career, you will start with smaller corpuses. So you start building it up month on month. And the biggest impact on investing is time. So a lot of you, who understand mathematics and formulas, if you go back to the formula of compounding, which is amount is principal into 1 plus r by 100 raised to t. The most powerful variable is not p or not r, but time, because it is exponential, it's compounding, it's raised to the power of t. So if you give time, you will win all battles in investing. And the only way you can give time is start early, because your end date is finite.
So I'm glad we've got a very young bunch of students. I think you really hit the nail on the head, Kalpen, when saying that time is absolutely essential. And Taher, I want to take off on that note. I think Kalpen really summed it up well by saying that it's not what you invest in, but when to invest. And if you could just enumerate on that and give us some of your pearls of wisdom as to what they should be doing.
So I kind of agree with Kalpen that you have to start early, but investing is a long haul game. It's not about the next 1 year, 2 years, 3 years. One has to be prepared to be invested for a longer period of time. That's essentially when you derive the real benefits of being in the game, being with the businesses that you like for a longer period of time. Let's also not forget the power of compounding, which we all know how it works for a period of 5 years compared to, let's say, a period of 10 years. So if you have to probably grow at 15% over a period of 5 years, 4 to 5 years, you'll probably double your money. But it'll quadruple if you were to probably be invested over a, let's say, a 10-year time frame. So the outcomes are of longer term investing are substantial and cannot be underemphasized. So while it is important to get in early, it is also important to remain invested for a longer period of time, especially for businesses that you understand, businesses that you like, and are able to do enough justice to and understand them well. So it's about that. Treat investing as like buying pieces of business, not like trading in stocks, or not like buying a piece of stock which today trades at X level and is probably going to trade at Y level tomorrow. That's not investing. That's more like speculating. So look at it as an investment. Look at it as, and when it comes to looking at it as an investment, you have to be cognizant about what the businesses are doing. You have to understand the business. You have to place a lot of emphasis on research. So that's something which is part of the grind. It is a very useful grind, and one will have to go through it. For first-time beginners who are probably entirely new to the investment world, and probably do not understand as much of the dynamics of stock picking or the markets, as even Kalpen outlined, look at the mutual funds, look at avenues to invest through these vehicles. These are good vehicles which have done very well in the past. It will get you started on your journey towards wealth creation and beating inflation, which are the two primary considerations in investing. So at least you will probably be a part of the journey. And once you come to a stage where you are reasonably equipped and you think that you can understand individual businesses, industries, companies, managements, then try and start building a portfolio of your own. But up until you do that, Sensex, Nifty, many other index-linked products are good products to start with. Let's not forget that the index was Sensex when it started off at 100 rupees in 1979, 35 years ago. And today it is about 26,000. So we are talking about 2,600 times 260 times actually the appreciation that you've seen in the market in this period, which works out to a CAGR of almost about 15-16%, which is not a bad CAGR at all. And net of inflation, it works out to about 10%. So it's a good way to start with. If you want to increase your returns, outperform the markets, get better traction, then you can probably start looking at building your own portfolios. But up until then, I think look at vehicles which are around for a long period of time with good quality managers in the system and very experienced performance as well.
Yeah, so I think getting started on your journey of wealth creation would perhaps be the key, and over here is where we will learn how to do that. And here's a problem that that we've addressed in previous shows as well, the lure of taking advice from, say, a friend or an expert, or falling for those market tips. It all sounds very glamorous. Put your money here and you'll make X. But Kalpen, sometimes people tend to get stuck or get their hands burnt in that kind of a scenario. So, any particular do's and don'ts that you would say, or any expert's advice that you would like to share with our students?
Yeah, so, just look at the law of nature. 700 crore people on earth, less than 0.5% have money or wealth. So, in a way, it proves that money is in the hands of minority. So, majority can never teach you how to make money because it would have been rich then. So by definition, there are very few who have mastered the art of investing and learned the principles of long-term investing. So few things that I have learned is, one, invest for really long periods of time. Don't get carried away with short-term flavor of the season, fashionable trends, short-term tips, short-term advice from friends, number one. Number two, invest in good asset classes, and various asset classes do make sense at different points in time. So, generally I've seen investors get carried away with one asset class after it has done very well. So there are periods when gold does very well, so everyone wants to invest in gold. There are periods when real estate does well and we start liking real estate. And then when equity does well, we run towards equity. The whole idea is to have a balance and always try and choose an asset class which, irrespective of how it has done in the past, has potential of doing better in the future. So investing is a game of going ahead, not going behind. So what asset classes have done in the past are not as important as what they can do ahead. So one, invest for really long periods of time. Ideally invest what is cheap. So they say that investing should be the way women buy groceries and not perfumes, which means demand a cheaper price, because the cheaper your price, the better your future returns will be for any asset class. And lastly, stick to discipline. I think the biggest raw material of investing is time and discipline more than anything else. Rightly, as you said, people do get carried away with advice. See, experts by definition have to be very few. So you really need to know. There is a lot of value of having an expert advisor or a friend who really understands. But the question you should ask is he equally rich for you to follow his advice? If no, then don't follow. Because
a lot of people regale their stories about how they made money, but no one actually acknowledges when they lost money. And Kalpen, I must say, with all those mathematical equations, you were definitely sitting in the front row when you were in college, weren't you? Were you a backbencher? Okay, so lots of potential for the backbenchers. And Taher, what about you?
I don't know, somewhere in the middle probably, but
keeping it safe.
So I was around for a while, I think so.
Okay, so let's throw open the floor to some of the people sitting in the front row. If you have any questions, so get the mic ready. But before that, I want to ask you, what is that one do or don't that you would definitely underline, Taher, for students?
So for me in my career, I think what has probably worked, and it's working very well for our organization as well, is that we've remained very, very focused. And that's something that you have to bring in at every level, not just in investing, but every aspect of life, in whatever you do. We've remained very, very focused. And that's something that you have to bring in at every level, not just in investing, but every aspect of life, in whatever you do. More importantly in investing, because India is a land of opportunities, for sure. I mean, we've got maybe 5,000 companies listed, 2,000 active, whatever the number is. But you can't do justice to a number of companies, So, and there are only certain areas where you can actually bring some expertise or build some expertise. So there will always be there's no need to pursue an idea a day. Leave that to the news channels. So that's something which will keep coming and keep hitting you every day. But we believe in the power of focus. We believe that less is more. And we see that in every aspect. We build that in every aspect. If you look at our product profile, we don't run more than 3-4 funds versus a lot of schemes which competition runs. All our funds are actually just about 20 odd stocks, if at all. So it's a very, very concentrated, high conviction portfolio. If you're running a portfolio with about 20 stocks, essentially on an average you're holding about 5-6% position. Some of them are even running at 9-10%. So they are significant bets. Now you can take these kind of significant bets only if you are fully convinced and if you have done enough due diligence. So like as I mentioned earlier, research, there's no substitute to that. So even in our team, while we are 4 or 5 fund managers and 5 analysts, essentially we are all analysts by definition. We all started our careers as analysts, and even today, even though we are nomenclatured as fund managers, we are ideally we are analysts at heart. So our whole effort is towards understanding companies, businesses as much as possible. And you can't do that with 1,000 companies, you can't even do that with 50 companies. So 10, 15, 20, you know the rule of diversification. Beyond a particular point, diversification is actually dilutive. So that doesn't work. So we would think bring in as much focus either in terms of sectors that you understand or companies that you understand as possible. Of course, do not trade and do not look at speculating. Take a longer term view. That goes without saying. So these are the 2 cornerstones in our view. And don't churn, of course. Keep your convictions going, but at the same time evaluate. You can't. There are very few businesses in India where you can actually just buy and forget about them for 10, 15, 20 years. It will only get lesser because the world is getting more and more competitive, and competition is affecting each and every business. So what you need to do is focus on a few of them and evaluate them at every stage, because you may need to change your course of action, you may need to trim, you may need to increase your allocations. That's the active part of management. But take a long haul view and keep things simple. Don't try to do things which are very complex, especially when you're beginning. Even at our stage as more experienced professionals, we try to keep away from companies which are very, very complex to understand. There's no need to do that. You need 10, 15 bright ideas maybe in a period of 2-3 years, and that's enough but back them with conviction. So that's the most important thing that I would profess.
And just like Warren Buffett said, and I think Kalpen, that's one of your favorite quotes that you gave us, it's not necessary to do extraordinary things to get extraordinary results. So let's throw the floor open. When I asked the students over here how many of them invest in the stock markets, everyone's hands shot up. So I'm sure we'll have a lot of questions from our bright students. And a backbencher, first up, introduce yourself and what's your query?
Good morning, sir. My name is Saurabh Pol, and my question is like with 2016 coming up, not just from a stock market perspective, which are the sectors which will lead the Indian growth story?
Would like to answer that.
Okay. So, we've typically, like as I was explaining, we've never taken a very deep sectoral approach to our investment process. Our process has largely been think companies, and that is the best way of going about doing things in investing. The unit size in which you think should be a company, not as much a sector or a business or a theme as such. So it has to be a business which appeals to you. It could be in any sector. It could perhaps be a very godforsaken sector for now, let's say commodities or metals or whatever, or it could even be some of the most loved sectors in the market today. So you need to be at some level sector agnostic. You need to be more worried about what that business machine is looking like, because ultimately you're buying something which is a business in the most simplistic terms takes in capital, processes the capital in some way and tries to deliver a return on that capital. So you have to see.
Allow me to interrupt here, because I totally get your point, but I'm sure his question stems from the fact that there's a lot of advice coming in. The 2016 is going to be a year where the government policies will kickstart, things will actually be implemented on ground. So in light of that, do you think that a tilt towards sectors that will benefit from this are likely to be in focus?
There is a possibility. I mean, if you take a very a narrow view of, let's say, about 2016, that what is the next 12 months likely to bring in store. So it's a possibility that industrials as a class would probably start getting a good amount of traction, and we are kind of, even we agree with that view, that we will probably see better manufacturing growth as we go ahead, especially driven by rates and commodity prices, which are both favorable for India. So you can make your base your investment decisions in let's say a sector like manufacturing. But once you even drill down that, the bigger challenge will come in selecting the company and what to ride, because all the manufacturing or all the industrials or all the construction and cyclicals are not going to perform at the same pace or in the same way that you would like it, even in 2016. So you have to again drill down to companies which make sense to you, which you understand, which probably are, in our view, don't leave quality to something which is in the background. Quality has to come first in deciding any company, be it in any sector. I would agree that industrials as a class would probably get traction. You would probably see continuity of even some of the consumer discretionary sectors. Autos is our prime bet, and that is one sector in which we have a lot of positioning. That's something which appeals to us significantly. We like the whole theme of or the idea that India's financial savings rate will actually start increasing, and that's where a large part of our portfolio exposure is towards. But again, within that, you can't take a blanket approach. You have to come to the grind, and you'll at some stage encounter a situation where you'll have to decide which company, is it A or B, and it could make all the difference even with the theme or with the tailwind of that sector for that particular year.
I think, Taher, you've invited a lot of questions post this interaction from all the students, but tell you what, we'll slip into a quick break. We have Kalpen, Parekh as well as Taher Badshah here to answer the questions of the students of JBIMS. Back in a bit. Welcome back. Still tuned into BNSN on campus. We're at the Premier B School, Jamnalal Bajaj Institute of Management, with our two market experts. And this certainly brings back lots of fun memories of college and the university days. And Kalpen, Parekh as well as Taher Badshah with us. We have some very enthusiastic students. So I'm going to go straight to you, sir. What's your query and what would you like to ask?
Good morning, sir. My name is Badshah. You spoke elaborately on long-term investing. And my question is that, is it right to say that investors are shifting focus to long-term gain, short-term gains rather than going long-term? And I'd like to back it up this fact by stating that average S&P 500 share today trades only for, is held only for 200 days. And a follow-up question would be, is it right to term this approach myopic? Because the business environment is very volatile, and investors who are particularly investing in startups who have no visible break-even point in horizon, they prefer easy exit and long gains, more gains. So could you have your views on that?
The startup story will get us too many questions, so let's stick to his answer.
Yeah, so I think you're right. Data globally and in India shows that time horizons have shrunk a lot. With a lot of information and a lot of information getting treated as noise, people react very fast. So like I said, the thumb rule is the value of your returns becomes bigger and impactful only with time. So if you earn 20% in 1 year versus 10% in 5 years, 10% in 5 years gives you a bigger absolute amount. So time is very critical. Investing has to be for decades, not for years. Having said that, like I said, discipline is a raw material for people who are in minority. Most people continue to invest for short horizons and for months. So 2 years, 2.5 years, 3 years, that's the time horizon, and they keep rotating these investments. So while the money is perpetual, but the choice of the underlying investment keeps rotating depending on market cycles and your own understanding and assumptions. But to be successful, it's very important to take a long view and stick to your plan, stick to your discipline, stick to the asset class or the investment that you've made.
Okay, so clearly if Warren Buffett was 11 years too old to invest, I think that really underlines the importance of time. So invest for decades. And we have a question right up front. Go ahead.
So good morning, sir. I'm Pranit Choria. In the last 2 years, we have seen the mid-cap and the small-cap have outperformed the large caps. Do you see the same trend continuing in the 2016 and the coming years?
Stole my question. That was what I was going to ask.
Okay, so I'll just repeat partly what Taher mentioned, that good investing is about investing in good companies, not necessarily in market caps. Having said that, there are periods when large caps do well, there are periods when mid caps do well. Last 2 or 3 years have been a period where, starting 3 years back, mid caps were at a significant discount to large caps, which means prior to 3 years, large caps had done well. So there was some amount of reversion to mean. One principle which works, very scientifically in markets is cycles, and cycles revert to mean. So there are periods of these adjustments, and you can't really pinpoint with finiteness that for how long will X trend work and Y trend work. These are good debates to have in hindsight, but what we look at is, is the company really good? If the company is good, is the company dominant in its segment? Is it a market leader? Does it respect capital? Does it invest its capital with focus wisely? If the answer is yes, then it does not matter whether it's a large cap or a mid cap or a small cap company. And that's the right way in which we look at portfolios. What has also happened in the last 2 years is a lot of money from retail investors has gone into mid-cap stocks, and that also has attributed to mid-caps having done well. But like I said, what has also happened in the last 2 years is a lot of money from retail investors has gone into mid-cap stocks, and that also has attributed to mid-caps having done well. But like I said, cycles mean revert, and over a period of time, good companies become better investments, independent of market cap.
I have a request as well from some of the enthusiastic people tuning in from the ET Now newsroom, and they're saying, let's get some stock-specific ideas going as well. 2016 holding a lot of promise. Taher, give us your one multi-bagger or long-term stock investment, wealth creation idea, let me put it that way.
Well, actually, I'm not too sure if I'm at liberty to actually call stocks, but I will only refer you guys to our portfolio holdings. Unfortunately, I can't display it here, but I'll just pull out the names that we hold in fairly large. Essentially, for us, are our multi-bagger ideas going forward, given that we've allocated so much. So, as I mentioned, at a sectoral level, we are significantly exposed to autos and banking and financial services. Those are two very large holdings for us. And within autos, I think we are seeing two areas where there is a lot of growth possibility, and those two being one is discretionary autos. Essentially, we are talking about high-end cars, high-end motorcycles. These are areas which to us...
Okay, some trading ideas coming in from BNSN campus, auto stocks, and clearly having an exposure there, and some key lessons coming in for investments. Let's quickly take a look at the markets as well and what's buzzing in today's session. Some stocks that definitely need a mention are Tide Water, doing very well in today's session and reviewed. We don't discuss this stock too often, but managing to hold out was fairly well, and heavy volumes being traded there. Tide Water gaining in double digits at this point of time, 13% of an uptick coming in there. Let's also flag off some other stocks like Orient, Abrasives, which is also doing very well. 6.5 points is what this one's gained. But Avanne, it's back to you while we were getting some key trading ideas for 2016 and some investment ideas too.
And, this concept of value migration for us has thrown up amazing investment opportunities in the last couple of decades. We've seen that when we saw the whole transition from in 90s, somewhere in the late 90s, when the whole scooter market became a motorcycle market. And we saw the result of that in the investment world when many of those companies which were leveraged towards the motorcycle market did exceedingly well. More recently, we saw that with the telecom industry when the whole fixed line market became a wireless market. And that was a huge value migration, which happened and which created a lot of value for investors. The more recent one that we think we are at an inflection seems to be in the area of, rail travel to air travel. And that's something which is just at the cusp, and it's getting the necessary wind.
That it's an Interglobe?
Yeah, that is, I don't mind disclosing that. It is a very large holding in many of our funds today. So that's something that we have invested significantly, and it also happens to be one of our top holdings.
Okay, we have a question right up front.
Good morning, sir. My name is Mayur Pandey. My question is regarding the pharmaceutical sector. When we research a stock in a pharmaceutical space, we look at the drug pipeline which is there in future. We look at the investor conference call and we see what drugs are there in the pipeline. We go back to Google what is the earning potential of those drugs. If we want to sharpen our focus on research, how should we do it?
Watch ET Now. I think that just answers it. So, Kalpen, any advice on how one should, sharpen their research, and if you could also share some of your top sectoral bets?
See, I would resist doing that, and I tell this to my father also, who asks me every Sunday that what should I buy. I always tell him that buy IDFC Premier. Over 10 years, it has compounded money at 19% CAGR, because stocks keep on changing and evolving, and today I'm talking to you, tomorrow I may not be there to tell you the other part of it. So, you know, as starters, because this audience is about first time investing, I would very strongly urge you to first look at simpler vehicles, number one. But I think, you know, the question that you asked is about going very deep and analyzing what companies are saying, reading their balance sheets, understanding trends, you know, looking at competitor inputs and feedback, how the whole industry is talking, what is the whole value chain talking, and going deeper and doing your homework before you make a decision.
Okay. So I think just to add, if I may, you know, while you've picked up a very complex sector as an example, my first submission would be that, or advice would be that, like I mentioned earlier as well, try to look at simpler things. Clearly, pharma is a complex business, and it's getting more and relatively more complicated now than what it was.
With those US FDA concerns also.
US FDA concerns, plus the way the business model is also evolving. I mean, in the sense that at some level, the last decade or 15 years belonged to plain vanilla generics, and now companies are evolving to the next stage. Particularly, the Indian companies want to get into the stage of complex generics, which brings its own challenges. We now, as Avanne rightly mentioned, we have a regulatory oversight which is getting more and more stronger. So it is not an easy sector to deal with. However, if it is a sector which excites you, which you have understanding about, which you're passionate about, it's something we'll have to go beyond just analyzing as to where, what are the drugs or what are the products which are in the pipeline. There can be substantial changes to the timelines of those pipelines, and part of it can also get disrupted more because of regulatory changes. So a couple of your plants go under surveillance and import alerts or some such, and you are set back by another 2 or 3 years. So you have to deal with those kind of challenges. So you have to come to a far more granular approach when you come to a particular company. It's best in our view right now to look at companies which are clear of US FDA hurdles for the next 2 years, so that you know that okay, most of their plants are inspected. Now you have a clear run up and you can probably exploit that. Or else you take a view that there are companies which probably have got multi-billion-dollar opportunities in their kitty, which are going to unfold anyways in the next 5 years, even though they might have challenges in the near term of FDA. So you take that view. Then you have to you have to take that time horizon as well into your competition. That look, I'm willing to wait it out, but I know that when the time comes, it will be a multi-bagger for me.
Okay, the questions have been dominated by the young gentleman. Let's go across to the lovely lady at the back who also has a question.
Good morning, sir. I'm Saloni Shah. My question is about, so we've recently been hearing experts say that companies that are exposed to the domestic markets over those that are dependent on FIIs or global growth cycles are better picks in the current market scenario. So do you concur with such a view?
So, yeah, I think broadly we are about that. I mean, we have in our portfolios tried to keep exposure to global sectors as less as possible, simply because of the fact that this is our belief. I mean, it's probably our handicap or our limitation of capabilities that we think we are better organized to and equipped to understand domestic issues and domestic industries and businesses which are focused more on the domestic market. Versus those which are far away from us and probably have challenges outside which we are not able to fathom, we are not able to understand. So again, coming back to the same principle, it's a part of the simplistic approach that let's keep things as simple as possible. If you can understand those global dynamics in which that business is involved in, then clearly there might be very good, interesting ideas and money-making opportunities out there as well. So to each his own, but for us, I think, yes, and maybe partly given the kind of global complications that we've had in the more recent past, domestic opportunities seem to, become much more simpler and much more attractive. But there's nothing stopping you. I mean, it's all about whether you can place that conviction in that global opportunity.
Kalpen, any 30-second answer, New Year's resolution that these kids should adopt for the markets?
Start investing and don't look at investing as a 1-year finite period. The resolution you need to make is to start.
Okay, so those are your 2016 finance resolutions. Thank you so much, Taher as well as Kalpen. It's been a very educative and interactive last 40 minutes. And thanks so much to this enthusiastic bunch of students. And with that, we wrap it up right here from JBIMS. Back to you, Kamya.
Thanks very much, Avanne, for those key trading ideas as well as some resolutions to keep in mind in 2016. Well, take a look at the markets at this point of time, and clearly we are seeing a sharp fall at this point of time, erasing all the gains. The Nifty advanced decline ratio is coming at 3:2 at the day's low for the Nifty at this point of time, but still marginally holding out in the green zone. Sensex also slipping in trade, and the Nifty Bank also underperforming, and only 6 banking stocks are advancing in trade. We get you a lot of market experts, expert take on the markets, and our guest for BNSN, the stock game, will be joining us on the other side. Stay tuned.
Find us on Facebook at facebook.com/etnow, and don't forget to click the like button. You can also follow us on Twitter at etnowlive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/etnow.